Hi there everyone, how are you doing? That's Professor Henrique Caesar. I am a prep provider for the CFA exams here in Brazil. And in this video here, the intent is to show you how we teach the CFA material in the classroom. Most of my classes are in Portuguese. We also teach courses in English, right? This is an example of an English class that I teach. So I chose a subject from the level 1, from financial statement analysis, and I'm going to show it to you how we teach that material. We teach not only the material, but we also try during the lectures to predict how the questions in the exam would be asked related to that topic. Right? So the topic again, FSA, financial statement analysis, we're going to show it to you how to remember or memorize, if you say, the ratios for financial statement analysis, the ratio analysis. So we're going to see here all the ratios that you need to know for level 1, level 2 as well, because when you go to level 2, you cannot forget what you learn on level 1, or at least most what you learn will be very helpful to remember for the level 2. But this one, the class today, this topic will be on level 1, financial statement analysis ratios. Right? Let's start. All right, everyone. So we're going to divide the ratios for level 1 in categories. We're going to divide it in 4 categories: liquidity ratios, activity ratios, solvency ratios, and profitability ratios. So all those 4 categories. Under each category, you need to remember few ratios, or some, quite a few in some cases here, like the activity ratios. Right? But in the case of liquidity ratios, only 3. Right? Solvency ratio, maybe 2 or 3. Right? Profitability ratio, well, profitability ratio, I would say probably all of them. But let's see one by one. Right? First, liquidity ratios. What are they? And which ones are they? So liquidity ratio measures the capacity of the company or the enterprise, if you say, to pay short-term debt with short-term assets. So what I call short-term assets are the current assets. Well, current assets paying current liabilities. Obviously, the more current assets that you have, the less current liabilities, the more liquidity the company will have. Right? The 3 most important liquidity ratios are current ratio, quick ratio, and cash ratio. The current ratio takes all the current assets, so the quick assets, all the assets that will become cash, right, in less than a year. Let's say that's the definition. But think about cash, short-term receivables, accounts receivables in general, short-term investments, the one that you can get it immediately, like money market, and the inventory. It does include prepaid accounts, but I do not see many examples of the CFA questions with prepaid assets, which is also a current asset. So let's focus on cash and short-term investments, accounts receivables and receivables, short-term, and inventory. Think about those 3. Add all those 3. Then divide it by the total short-term liabilities, the current liabilities. So it's included all the current liabilities, the most common: accounts payable, salary payable, tax payable, and one that you should not forget, the current portion of long-term debt. Current portion, long-term debt, is due this year, therefore is a current liability. So you add all the current liabilities, then you take all the current assets, divided by the current liabilities, and then you have your current ratio. Obviously, right, it's easy to interpret this ratio, I think. Right? On the numerator, you have assets. On the denominator, you have liabilities. In general, we want more assets than liabilities, so we want to have a ratio higher than 1. There you go. So if this ratio is higher than 1, it's good. There's some liquidity in this company. There you go. But now imagine that, for you to accomplish paying your current liabilities, you're going to have to sell your inventory very quickly. So therefore, you might not be able to sell your inventory for the value you wanted. In this case, you're going to have to liquidate your inventory. So let's say companies don't want to do that. If they have like an expensive inventory, or if they have like an inventory they're going to need it, right? Or if they have an inventory which will have a very high gross margin, right? So it's not the interest of the company to sell that inventory very quickly. So the idea is, can we pay the short-term liabilities without selling our inventory? And then we have the quick ratio. The quick ratio is the current assets minus your inventory on the numerator and your same current liabilities on the denominator. And if it's still higher than 1, because you want to have more cash, accounts receivable than payables or short term, so if the ratio is higher than 1, it's good. The liquidity is present without even selling or liquidating that inventory. And then you have the third one, that's called the cash ratio. And the cash ratio means just enough cash in short-term securities that could become cash very quickly, divided by the current liabilities. So this one is debatable if we want a number higher than 1, right? Because if we have too much cash in the company sitting around without being invested, without being creating value, might not be a good idea. So if the company doesn't have enough cash to pay the short-term liability, in other words, they have a cash ratio that's lower than 1, it's not the end of the world. It could be because the money is being used for a project or some kind of process that will create more value for the company. So it's understandable that there's no cash available. It's important to have a certain amount of cash, but not necessarily not having a cash ratio higher than 1 will be necessarily a poor performance. However, if we want to follow the rules here in terms of liquidity, and if the company wants to pay all the short-term liabilities with cash, it might not be able to if the cash ratio is lower than 1. Okay, there you go. Liquidity ratios. Now let's go to the next classification of financial ratios. All right, everyone, the next one, activity ratios, right? Or also called efficiency ratios. So think about that activity. I want to measure turnovers. I want to measure the number of days of something, number of days to receive cash from my customers that owe me money, number of days to turn around an inventory and sell completely, number of days to pay my suppliers. This is important. Those are activity ratios. On this category, we also have the operating cycle and the cash cycle of a company. So let's go. All the turnovers, let's think about all the possible turnover ratios that could appear on level 1 exam. So they are 5. The 3 most important ones: receivables turnover, inventory turnover, and payables turnover. Okay? And then we have the fixed assets turnover and the total asset turnover. Those are the 5 ones that could appear in the exam. All right, so how to memorize those ratios? Well, there is some techniques. I would say, for example, the name of the turnover is the denominator of the turnover ratio. What do I mean by that? Think, receivables turnover. So there will be a ratio. Ratio is A divided by B, right? Something divided by someone else. Who is someone else? Who is in the denominator? The name of the turnover. So accounts receivable, receivables turnover, the accounts receivable is the denominator. Inventory turnover, the inventory will be in the denominator. Payables turnover, the accounts payable in the denominator. Fixed asset turnover, fixed assets in the denominator. And total assets turnover, guess what? Total assets in the denominator. And what do you go in the numerator? Well, for receivables, total assets, and fixed assets, think about sales. I want to know, sales are directly attached to accounts receivable. The assets we buy is to create more sales, right? And the fixed assets especially it's to create sales. So assets and accounts receivable are related to sales, right? So sales in the numerator and the name of the turnover in the denominator. So receivables turnover, sales divided by accounts receivable. Fixed asset turnover, sales divided by accounts receivable. And total asset turnover, sales divided by accounts, total assets. Sales means revenues, right? So it could be revenue as well. Good. Well, kinda. The ratios that include an account from the income statement on the numerator and account of the balance sheet on the denominator. Because the income statement is a dynamic statement and the balance sheet it's a more static statement, right? We sell every day, we pay expenses every day, but we don't buy machines every day, right? We don't pay debt every day. So it's kind of like the balance sheet is a little bit slower, right? Compared with the income statement that's very dynamic. Well, to add some more dynamic into the ratio, we do the average of the balance sheet account that would be in the denominator of those turnovers, right? So sales divided by accounts receivable now is sales divided by average accounts receivable, right? Sales divided by average fixed assets for the total fixed asset turnover, and sales divided by average total assets for the total asset turnover. So it's the average fixed assets, average total assets, average accounts receivable, average inventory, and average payables, precisely for that reason, because in the numerator you're going to have an income statement account, and on the denominator you have a balance sheet. You need the average. So you take the beginning of the year, end of the year, divided by 2, you add some more dynamic, huh? It becomes more dynamic, let's say, the number of the balance sheet. There you go. That's the explanation about the average. I hope you don't forget it anymore. Right. For inventory and payables, what do I put in the numerator? For inventory, cost of goods sold. That's their type. Inventory, cost of goods sold. And for the payables, you can either put cost of goods sold, but the best one will be purchases or net purchases of the year. It should be given in the problem. We don't usually see net purchase on the income statement, right? Cost of goods sold we can get from the income statement, but net purchases is usually we have to calculate or has to be given in the problem, in the question for each one. But there you go. Those are the 5 turnovers, right? Now, the higher the turnover, the better. Yes, except for the payables turnover. All the other turnovers, you want to as quick as possible, right? For example, receivables turnover. I want to think about that. I want a 365 turnover. I want a turnover of 365 times. That's the idea. So receivables turnover, 300 equals to 365 means that 365 times during 1 year I get paid. Think about an inventory turnover of 365. That means that during 1 year, I turn an inventory around, I sell an entire inventory 365 times during 1 year. Think about that, right? About my fixed asset turnover, my total asset turnover, if they're 365, that means that you are making a lot of sales with very little amount of assets or fixed assets, in the case of fixed assets turnover. Which is good. If you can make a lot of sales without investing much assets, well, that's good, right? That's efficiency, right? That's an activity ratio. There you go. Now, accounts payable turnover or payables turnover, you don't want it too high, right? Imagine if your payables turnover is 365. That means you pay suppliers every day. That's not a very efficient use of cash, right? That's not very the efficiency of managing the cash flow, it's not good. You're paying every day. Could you negotiate and pay every 30 days? That would be much better. If you could pay every 30 days instead of every day, well, then you have 30 days to come up with the money, right? So if you turn an inventory around in 1 day, get paid in 1 day, and you have 30 days to pay, that's amazing, right? So all the turnover ratios equals to 365 are ideal. Payables turnover equal 1, it's ideal. Right? Think about that. Good. So now, how do we transform the turnover, the times, into days? Well, if you think about 365, right? So a turnover of 365 means every day. So all we have to do is take 365 and divide by the turnover that you just found using the formula. And formula, by the way, here on the side, right? Those formulas. So calculate the turnover, and then take 365 and divide it by that turnover to get the number of days, right? Called days in. So days in receivables, how long it takes to get paid from my clients. Days in inventory, how long it takes to sell one full inventory. Days payable, how long it takes me to pay suppliers. So those are the days. So the quicker I receive, the quicker I sell an inventory, and the longer I pay my suppliers, that's the most efficient way to manage the cash flow for, in this case here, for the net working capital. Right? We're talking about accounts receivable, accounts payable, inventory. Those are working capital. Okay, there you go. So think about 365 as an ideal turnover, and 365 divided by 365 equals to 1. So 1 for all the turnovers except accounts payable, it's great. Good. Think about it, a turnover for payables equals to 1 turnover during the year. So if I do 365 divided by 1 is 365 the days in payables. That means I only pay my suppliers once a year. That would be ideal scenario. Can you imagine? You're selling every day, you're turning around that inventory, you're getting paid, but then you take 365 days to pay your suppliers. That's a very efficient way to manage a business. Now, think about that, because that's going to be helpful for you to understand the cash cycle and the operating cycle. Operating cycle is the days inventory plus days sales. So think about 1 day inventory, 1 day sales equals to 2. That will be an excellent operating cycle. 2 days, amazing. So the lower, the better for the operating cycle. Now the cash cycle is going to be the days inventory, days receivables or days in sales outstanding, depending, minus the days in payable. So I'm going to subtract the days in payable. So imagine, right, that my days in payable is 365. It takes 365 days for me to pay. So I have a credit period of 365 days. So imagine if I put all those three together. 1 day for turning around, one inventory. 1 day to get paid. 2 minus 365 payable equals negative 362 cash cycle. Is that good or bad? Excellent. A negative cash cycle, it's amazing. Negative cash cycle is excellent. Negative cash cycle, it's what you want. You want to get paid first from your customers, and then, and much longer, you want to pay the suppliers. That's the idea. So a negative cash cycle is good. Right? So remember, cash cycle could be in the exam. Absolutely. They could give you a little table, company A, B, C, days in sales, days in inventory, days in payable, and then the question, which of the companies on the table above A, B, C most likely have the best cash cycle? And then you have to do the computation. There you go. Classic questions on the review material, which could easily be a question on your exam. Good. Those are the activity ratios, also called efficiency ratios as well. Let's go to the next category now, friends. Right, so the next category, solvency ratios. Oh, solvency ratios. Solvents, long term. Solvents means, the company is going to be able to survive in the future. That's solvents. So think about long term. Liquidity, think about short term, right? And solvents, or solvency, with an Y in the end, solvency, long term. Ability to pay debt on the long term. Ability to survive in the long term. Those are the solvency ratios. I believe 3 of them are the most important ones. The famous debt to equity ratio, the famous financial leverage, and the not too famous debt to total capital ratio. Right? But the good thing about that, except for the financial average, the name tells you what's goes on the numerator and what goes into the denominator. Debt to equity. Debt divided by equity. Long-term debt divided by equity. Okay? Financial leverage. It's total assets divided by total equity. That's leverage. Leverage means the amount of debt, right? So that's a way this ratio captures that, because if your assets is 100, right, in your ratio, in your equity, right, it's 50, right? So obviously, right, the assets are 50 times or 50 points higher than the equity. That's because debt. That's because leverage. If my assets equal my equity, so my financial leverage equals to 1, I do not finance anything with debt. That's the idea of the financial leverage. So financial leverage is good, right? Because that helps the company to grow. Right? I always have that little joke. The best way to finance your business is the OPM finance, other people's money finance. Take the money from someone, borrow, don't sell stocks, borrow. Say, hold on a sec, I'll pay you in a year. Take the money, open a business, generate sales, generate cash flow, pay your debt. Boom, pay your debt, and now you have a business. And where the money came from? Well, we got a loan, now we paid it back. Beautiful, right? I create a business with other people money, paid back, business mine. Okay, think about that, right? So to help you to understand how those ratios work. I know in real life this is almost impossible to happen, but again, we're teaching you the material here, and the best way for you to get it, right? To memorize the formulas, to understand how it works, because it might be very helpful in the exam. Right? So those are solvency ratios. Right? Now, I don't think that's my opinion, by the way, tend to show much on financial statement analysis. That to equity, for example, will show up with more probability in equity for you to calculate the, for example, weighted average cost of capital. That's more actually corporate issuers, if you may say. It could be appeared in equity as well. I don't know if the DE ratio will show up on FSA, but hey, everything is possible. Huh? Financial leverage, yes, definitely chances to show up either in equity or financial statement analysis. In equity, because the financial average is used on the DuPont identity to calculate the return on equity. And the return on equity is used in the topic of equity for the CFA exam. Who remembers the formula of the growth rate? The sustainable growth rate. The formula that you must know. ROE times B. B means the retention ratio. ROE times B. ROI times B. What's B? Retention. What's ROI? ROE, return on the equity. So if I take the return on the equity multiplied by the retention ratio, the percentage of profit that we put it back in the business and do not pay as dividends, that percentage of retention multiplied by the ROE gives you the growth of the company. So ROE, which could be calculated using financial leverage, could appear on equity. For you to demonstrate that you know how to do the growth rate calculation that you could use on the dividend growth model, right? Or other models that require growth. That's the idea. So I'm connecting the dots here for you, okay? The debt to capital, to total capital, is one that I might not even expected you see in the exam, but if it is there, what is total capital? It's debt plus equity, right? So debt to total capital is the debt on the numerator and the total capital on the denominator, as you see here on the side on the formulas. Good? Let's go to the last category now, profitability ratios. My friends, profitability ratios, you need to remember 5. There are more than 5, yes, but I'm gonna focus on 5. Because if you get the idea, then if another ones appear, you know what you do. For the first 3 are margins. What the heck is margin? Margin, it's anything divided by sales. Anything divided by sales is a margin, right? So fixed asset divided by sales, which does not exist, by the way, but fixed asset divided by sales will be fixed asset margin, right? But we don't use that one. But think about that. Anything that finishes with the word margin is divided by sales. Who or what is divided by sales? The name of the margin. So how easy it gets, right? So gross profit margin is gross profit divided by sales. Operating profit margin is operating profit divided by sales. Operating profit is your EBIT, earnings before interest and taxes. Could it be EBITDA or EBITDA, earnings before interest, tax, depreciation, amortization, divided by sales? That's EBITDA margin. Net margin is the net profit, net income divided by sales. So anything that finishes with margin is divided by sales. And the name of the margin is the numerator of that ratio. Boom, that's it. There's no average. No, there's no average because gross profit and sales comes from the same statement, the income statement. Operating profit and sales, net profit. So all the profit comes from the same document, the same statement as sales. So no need for average here. Okay? On the solvency ratios, all of the ratios, all the accounts, the numerator and denominator comes from the balance sheet. No average there. Then we have ROI and ROA, ROE, ROA. R of return, O of off or on, and E, equity, A, asset. The O means division side, is the division side. R divided by E, return divided by equity. ROA, return divided by assets. Which return? Net income. So net income divided by equity and net income divided by assets are going to give you ROE and your ROA. Well, where is the average? Because we need, net profit comes from the income statement, equity comes from the balance sheet. You said you should put the average there. Yes, I did say that, right? Why we don't use it? We do, not common. Okay, ROE and ROA are more, it's like an equity ratio rather than an accounting ratio. So the equity ratios usually will not present you with the average. It's more the accounting ratios that would present the average. Okay, so ROE, ROA usually don't have the average equity or average assets, but again, you might see somewhere with the average, right? Because they should follow that rule. Net income account on numerator, so the average balance sheet account on the denominator. ROE, ROA usually do not follow that rule. Okay, return on, return divided by, that's it. Good. Profitability ratios, friend. Those are the 5 ones that you should remember for your exam. All right, there you go. Those are all the ratios that I believe you should know, the ratios from the FSA, right? Financial statement analysis. You will see other ratios on cash flow. We didn't see any cash flow ratios here, that's true. So that will be for the next video, because cash flow ratios deserve to be one video just for that. Because cash flow ratios, you have several different cash flow ratios, one for each type of analysis, like the cash spent for investments. So there's a ratio for that. The cash for payments of expenses or operational expenses, there's a ratio for that. So we have several different ratios with cash flow. Well, we're going to do this on the next video. But as far as for liquidity, solvency, profitability, and activity ratios, those are the ones you need to know. And pay attention and remember your cash cycle, in your operating cycle, in your turnovers, because I think those are the ones that have a tendency to appear more often on your level 1 exam. Okay, that's it, friends. I hope you understood the method we use. I hope you like it, this style we have here. I like to present you the information. I like to give you techniques to memorize the information, and I also like to connect that information with future topics, so you can see this whole exam as one big thing, right? There is a purpose why we start with quantitative methods and finish in portfolio management. There's a purpose for that. Okay, well, I hope you enjoyed. If you like it, sign up, subscribe to the channel, send me a message, give your like. Right? I'll be here. I am here to help. So any suggestion of videos that you may have, I'm here to listen. I know definitely make it the wishes of everyone that's following me here. Right? I want you to pass this exam on the first attempt. I always say that, and I will do anything I can to help you. So feel free to reach out. Bye-bye.